Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. Okay, we were talking about municipal bonds. One of the things I want to cover just real quickly with this is this. Interest rates being lower means that the bonds, in fact, there's another article, the Fed put a 50% tax on your retirement plan. That's how they're countering, and this is from Forbes, this is how they're looking at the impact of these low interest rates with regard to pension funds. So imagine this, I'm going to have to pay all my retirees a certain pension. They've been promised this. We're going to pay this. They're going to get this, and maybe it even has cost of living increases. To do that, I have to set aside, I have to save a certain amount of money, right? Kind of like what we do in our individual lives, isn't it? So they have to now imagine that a municipality or a state has to set aside a certain amount of money to do this. Now, what happens is when they set that money aside, it's not just going to sit there and not do anything. They're going to invest it. So it's going to be invested in some type of portfolio, combination of stocks and bonds typically. So now when they do that, their projections are based on earning a certain amount of interest, if you will, on the bonds, a certain amount of yield or growth on the stock portfolio. So if all of a sudden those things go way down and they in fact are about half what the projections were originally, and they've been underperforming for the last 3 years at least. Okay, so what are we seeing then? We've seen that these pension funds are increasingly becoming underfunded. I set aside the money. I expect a certain rate of return. That rate of return is going to make sure I have enough to meet the obligations of paying those pension checks. But all my returns are lower. I therefore don't have the money. What's my choice? I have to, I may start taking more risks to try to increase that return, which could put me at a default rate higher. That could be disastrous. The second thing, fortunately, we have fiduciary standards, and there's, that is going to be somewhat controlled. But the second thing has to do with what? Just like anything else, if I'm not making as much of my money, and therefore it's not going to be enough to cover my retirement, I got to do what? Well, I've got to put in more money, right? I've got to put more money in the fund. What's the problem? The problem is that they don't have as much tax revenue. There's not enough jobs out there, enough people paying into the tax system. So what do we get? We got lower tax revenue, and then they still have current services they have to provide. They got to pay for those police and firemen and other, other services provided on that city, county, or state level. That still has to be done. So it's squeezing everything, right? Those tax revenues, which goes to the point about tax revenues or the likelihood of tax increases, of course. But the other thing, it's not going to get fixed until we get more people paying in, which of course means more jobs and the like. And even then, we've got this problem now that is developing of underfunded pension funds, which means the lack of ability to pay. And what's that going to mean in the future? They're either going to have to renegotiate with regard to being able to reduce it. It's putting this squeeze on that tax revenue, though. Now, what have you done if you've loaned that entity money? Might it make it also more difficult for them to pay? Is that why we're seeing many defaults around the country from city, county, and municipalities where they've not been able to pay those municipal bond holders what they owe them, and maybe in fact have to file bankruptcy, and those bondholders may get little, if any, of their money back. So these are some of the risks out there with munis as well that you need to be aware of, and why that risk is growing and what impact it's going to have. What do we get into with all that? So I talked about stocks. I've talked about bonds. Now I've talked about munis a little bit, and we're going to lead into talking about fixed index annuities. This is one of those areas. A lot of people I talk to every time, they come in and they say, well, annuities, I've heard, with annuities, they're run the other way. I don't know, anything about annuities. Today we're going to learn about annuities, all right? You're going to understand how annuities work, which ones to avoid, and there are a great many of them that you need to avoid, but also how they work and which ones can possibly be of value to you, all right? So we're going to start this with regard to the roadmap. We'll start at the beginning. Client comes in, we're going to set up a roadmap for them. This is basically the basic financial plan. I need to know what your income is, I need to know what your expenses are, I need to know assets and liabilities, all of that to develop a comprehensive plan. So once we know those things, as you can see here with this roadmap tool that I use as a way to illustrate, in the bottom left there you will see lifestyle income sheet total. So once that lifestyle expense worksheet is completed, we put that number. That's how much you spend each month to maintain your standard of living and quality of life. So we don't, it's not about a budget, it's about, everybody has their own form of budget, I suppose. But what we're talking about here is what is the financial measure of your lifestyle? What, to allow you to do the things you enjoy doing, to go on vacation, to do whatever it is, week in, week out, month in, month out, year in, year out. What is that average monthly cost? Then that's the amount that we want to have in a checking account to pay our bills, right? That tells us that's how much we're going to spend every month. So therefore, let's have that amount set in there so that as the bills come in, we're able to pay them. We're not waiting for, living, hopefully not having to live paycheck to paycheck, worrying about the check coming in so that we can pay the bill, but that we're at least a month ahead. The next thing is your emergency fund. The next one down. The emergency fund is going to be that about 3 to 6 months, ideally 6 months, of those expenses. So if it's $5,000, that would be $30,000 you need in an emergency fund. The emergency fund is for the unexpected things. So it needs to be kept liquid in a money market, checking account, savings account, that type of thing. So it's not going to pay much. When you look at the interest rates I've got listed there toward the right of those columns, those are historic rates, and it shows that if we look over the long term, over the last, say, 15 or 20 years as an example, or even longer, that we see those kinds of averages have been there. It's hard to imagine today when interest rates are so low, but there was a time when you could get easily in that 1 to 3% on your money markets, and when you could get on one-year CDs 4 or 5% or more, okay? But as I said, there's going to be a while before we see those days again, most likely. Now, next thing, short-term fund. If you're looking at planned expenses, so emergency fund, unplanned expenses, the car breaks, something in the house goes wrong, you got to fix it, you got to fix it now, you need the cash to do it. All right, the next one is your short-term fund. This is the fund that you use when you're looking at planned expenses. This is saying I'm saving up, in other words, maybe to replace a vehicle, or maybe something around the house is going to be needed. Maybe it's a renovation or even on the house. Whatever that might be, that's what that's for. And then last is your long-term fund, and this is your retirement savings. This is IRAs, 401ks, 457s, 403b, your thrift savings plans, traditional IRAs, of course, Roth IRAs, and maybe just savings like stocks and bonds, ETFs. Things that that are in the market where there's more risk, and you need to be able to be investing for the long term. Ideally, that would be like 10 or more years. That's where we're looking to get, as you can see, in that 4 to 9% range. Our goal is to get up in there to stay ahead of what? In a big red box, inflation and taxes. Okay, that's why that's so important. And that fund, that long-term fund, is where we're going to pull income from in retirement to help supplement our lifestyle, replenish an emergency fund or long-term or short-term fund, whatever may be needed. We need to earn more on that money. Okay, how do we do that? The next slide is on the 3 worlds of investing. And this is one of those areas when we're getting into talking about how to stay ahead of inflation and taxes. There are basically 3 worlds, if you will, 3 ways in which 3 groupings, if you will, of investing. So one of them is safety and protection there on the far left. So things like your savings, your checking, your money markets, your bank CDs, that kind of thing. Government issued things like savings bonds or treasuries. Insurance companies have what are called fixed annuities. Now this is maybe your first thing with fixed annuities. So let me explain how fixed annuities work. If you look at the bottom left there, one of the things with fixed annuity, with all of these things in this world, in fact, is your principal is guaranteed, interest is guaranteed, and there are penalties for early withdrawal. So we want to make sure that we match up the term with what the need is. We're not going to put money away for 5 years. We're going to need in 3 years, as an example. Now, fixed annuities like CDs do just that. They pay you a specified amount of interest for a specified period of time, at the end of which you can either reinvest with them if you like what the new interest rates are, or you can move your money somewhere else. That's just like with a CD. Okay? One of the differences with fixed index annuities, they usually allow you a 10% access to your principal and interest over the period of the term of the annuity. So if it's a 3-year annuity, you can take out, or a 5-year annuity, you can take out 10% a year until, if you wanted, okay, it's available to you. Whereas CDs usually limit you to only being able to take out interest only. The principal you have to leave in there. All right, some other differences are with fixed annuities. They grow tax deferred, of course, and of course CDs do not. So that's another difference. So when you're comparing, you're mainly looking at what's going to give me the most interest. If the CD is paying 1% and the fixed annuity is paying 2%, and they're both 3-year or 5-year or whatever it might be, well, then there you go. It's an easy choice, and that's a way to get a little extra earnings on your money. So a fixed annuity is a very easy one to understand. It's pretty plain and simple. There's also what's called an immediate annuity, and this is where you put money into an annuity with an insurance company, and you're saying, I want you to pay me income guaranteed for life based on this amount of money, and they'll give you some number that will work for that, and that's one way you can offset longevity risk. All right, now the next world is that on the far right of the stock market, and this is like mutual funds, stocks, bonds, ETFs, REITs, real estate investment trusts, which in my mind you should avoid REITs, by the way. I'll explain that anytime. Insurance, variable annuities, you can see the big red X there. Yes, this is the majority of annuities, by the way, that are in the marketplace, sold by broker-dealers and many banks and the like. These are variable annuities, and this is where you're taking on all the risk of the stock market, plus you have additional fees that reduce your return. This is why I'm not a big fan of variable annuities. I say avoid variable annuities, in fact. Your principal is not guaranteed. Interest is not guaranteed, all right? If you've got stocks, bonds, mutual funds, exchange-traded funds, REITs, again, variable annuities, all of this applies. And this is the big one. You need time. If you're going to be invested in the market, first off, let's invest correctly. It doesn't mean because you have a stock or a bond or a few of them or a few bond mutual funds, or certainly not with variable annuities, it doesn't mean that you're going to have that success whether you're in the market for 2 years or 10 years or 20 years, all right? Because those things may not perform as the broad market will. And that's what we're going to be looking at is when we're talking about investing in the market, is the broader market. And I've talked about portfolios that would be more appropriate that are going to have 10, 12, maybe even 15, 16,000 different stocks in them. That's a diversified portfolio. That's going to give you market return when it's done correctly. Okay, and then the third one again is the middle world is that of index annuities and index CDs, by the way. Banks have what are called index CDs that work similarly. So here, much just like we compared CDs and fixed annuities. Here you start with all those guarantees where your principal is guaranteed, some amount of interest may be guaranteed, penalties for early withdrawal, but a link to the market through some type of an index. I've got the S&P 500 index listed, could be the Dow Jones Industrial Average. We can go ahead and get rid of that slide now. So here's the thing. So any index, and there are new indexes, and I'm going to show you some of these new indexes coming out because companies are getting more competitive in trying to provide you with something that's going to help you solve this conundrum we're talking about of where to invest, how to invest. Wharton School of Business did a report a few years ago, talked about fixed index annuities and compared them with returns, compared quite favorably, in fact, with returns on the stock market. Another report showed where if you blend together fixed index annuity and a stock portfolio, how that could give you the highest success rate with regard to not running out of money during your lifetime. In other words, those two together work better than stocks and bonds or stocks in any other type of asset category. So it's understanding how these work. Having said that, just like I was mentioning with a stock or a bond or a mutual fund, you can invest. Junk bonds are certainly not a good way to go. When we're talking about investing in bonds, we're talking about investment grade bonds, short-term investment grade bonds, ideally. Okay, they're not going to give you the yield, but they are going to give that negative correlation we're seeking and help reduce your risk with regard to the market. The next is when we're talking about stocks. When I'm talking about investing in one stock or 2 or 3 companies, there's a much greater risk there that if one of those companies goes out of business or goes bankrupt, you could lose a great deal of your money. If on the other hand you've got 10 or 12,000 or more companies, and if you go out of business, that has a very minimal effect on you. All right? And that's how you can protect yourself. So it's investing correctly in the stock market is what works, and it's the same with annuities. Variable annuities, again, you're basically investing in the stock market. You've got sub-accounts that are investing directly into the market, and these sub-accounts, based on their return as to what you're going to do. But the biggest problem is that you've got higher fees. You could be looking at fees of 3 to 5%. That's coming off of your bottom line. So whatever the market does, you're giving them like a 3 to 5% hedge that goes away, and then you get it has to earn above that before you make anything. So this is why variable annuities can be a problem. Now we're going to get into more about index annuities and how they work. And here's the most important. Those of you that have annuities, I want you to pay particular attention to make sure what kind of annuity you have and what your risks are in that annuity, just as I've talked about with stocks and bonds. So join me here. We'll be right back on the Retirement Report.